Hello and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby Kinzer.
And I am Thomas Doty.
And we are the FITT Show, financial information for today and tomorrow, helping our people get their finances in shape. Welcome everybody out there in virtual world. It's such a pleasure having you joining us again on this wonderful occasion where we get to spread knowledge about finances in personal money management. Now, last week we talked about how the Fed rate can affect you. And this week we're going to be talking about inflation. We've mentioned inflation throughout a couple of our sessions, but tonight we're going to talk about how, or should I say, strategies to combat against inflation, because it affects in so many different ways. Some places it doesn't affect at all, some slightly, and some major. So we're going to talk about the kind of strategies that you can protect your portfolio with. So please make sure you click on the like buttons and the heart button as always. And please put comments down in the box, because we definitely get better, what they call traction. It expands out to more people, more likes, and the more comments you put in there. And look, if you have any, opinions about things we say, put them in the comment box, because we like to share them with other people. So do that. And don't forget to share on Facebook. But also, if you're out there on YouTube, please subscribe to our FITT Show channel. So with that, Dope, how's everything going?
Everything going good. If we have any technical difficulties, it's because I'm in Cleveland instead of at home and celebrating my mother's 102nd birthday. So,
whoa, all right.
All's good.
That is absolutely wonderful, man. That is great. Happy birthday to moms, man. So, Dope, cool. Let's give that stock market update. How the stock market looking these days?
Man, we had a real good week, but as we always say, there's going to be volatility. There's going to be ups and downs. The Dow is up over 400 points this week. That's only about a 1% increase on 34,000. The NASDAQ, though, it's up 700 points over last week. That's about a 5% increase, which is that's a lot in a week, but it still has a ways to go to catch back up to its previous high. And all the stocks I have went up except for one. Microsoft's up about 11 points. It went from 293 to 304. It's about a 4% jump. Tesla's the big mover this week. Tesla's up 144 points. It went from 869 to 1,013. That's a 16.6% increase.
Whoa.
Apple had a pretty nice week too. It went from 160 to 174. That's almost a 9% increase. My only loser this week was Pfizer, which went from 54.35 down to 52.59. That's a 3% drop. But again, that was my dividend play. And as I told you before, Pfizer pays a 3% dividend. So any growth I get in that is just gravy. I basically bought that for the dividend.
Wow. That's
so all in all, a good week, but it's going to go up, it's going to go down. Things are really in turmoil right now with the war, inflation, interest rates. There's all kind of stuff going on. So you can expect this ride up and down to continue for a while. But I personally feel I have a good portfolio of good solid stocks, and they're going to go down when the market goes down, and they're going to recover when the market goes up. But I think long term, I'm going to make a lot of money, and that's my plan.
And we talked about it before, about understanding the stock market, and just want to remind y'all, like, there is a thing what they call the correction, where some stocks have been selling higher than they should be, having higher PE ratios than they should, and some are lower, and it's called a correction in the market. And that usually they say it's like a 10 to 20% correction. And then what they call 20% or more is like they call a market crash. So we've been close to that 20%, but we've gone there, but it's been up and down, and don't nobody know. Even the top financial money managers. They don't know. Half are saying that it's going to be a bear market and we are headed to a crash. The other half are talking about it's going to be a bull market and it's going to come around and cryptocurrency and everything is going to take off. So the bottom analysis, don't nobody know. But that's why it's so important that we always talk about making sure you have the proper asset allocation and asset mix so that it doesn't matter if the market's up or down, a pandemic or not, an election or not, a war or not. You can be able to take on some of the shock from these different events that affects the market. And overall, you'll come out and you will increase your wealth. Though my stocks, man, semiconductors, which I tell people, y'all, you really need to consider those kind of stocks because we always talk about the iPhone and we talk about the cars, the electric cars. We talked about the combustion regular cars. We talk about, I mean, it's watches. These semiconductors are in everything. We sometimes we look at the product that is in and forget that these semiconductors are in these products and that drives the price too. So like NXPI, which is semiconductors in most cars, Mercedes, Benz, Lexus, and a lot of Asian cars. My stock last week is up $7 today. It's like $190.08 per share. And they paid a dividend of $3.38, which is about 1.8% dividend payment. The other one that we talked about before, I have this particular stock that's a supercharger for electric vehicles called OZOP. OZSC is the symbol. And last week it was up 6%. This week it's down 1%. So you never know, but it's selling at 2 cents a share. So there's some kind of stocks that you might afford. But remember, it's all risk, and we're not telling you to invest in the stocks we're in. We're just sharing you some of the stocks that we're in, and you can, follow with us how they go up and down, and sometimes psychology behind them. I've been eyeing Ford, though. I told you about that because one of those American car companies are going to jump out there and start leading in the electric vehicle. And Ford is now selling at $16.83. So another stock, though, I was looking at Procter & Gamble. Procter & Gamble, especially in these inflationary times where prices are going up and increasing, man, I was like, man, well, those staple, they call them the staple stocks that, sort of goes with the economy. And Procter & Gamble, though, I looked into them, man, they got almost so many products I didn't even know, like Pampers, Downy, Tide, Bounty, Gillette, Head & Shoulders, Old Spice, Mr. Clean, Crest, Secret, Ivory Soap. I mean, they got so many products. So it might not be a bad idea to look at that stock, see if prices are going up. And that's what people are going to be buying. Maybe Procter & Gamble is not a bad gamble. Play on words.
Hey, Bob, and
yes.
people buy those things, good times, bad times. You
right.
need Pampers and Charmin, and no matter what's going on, you need those things, and that's why those kind of companies do well. They're recession proof.
And let me see what Procter & Gamble is selling at $105.08 per share. It's year to date. It's up 7.6% year to date, though. So just a little tip out. Just a little, we're not saying do it, but we just keeping an eye on things like that. So, dope. My cryptocurrency update, right? Now, I told you before the cryptocurrency market about 6 months ago to a year, the market cap was like $2.7 trillion, meaning that's how much shares it had in the market, $2.7 trillion. And it went down last week. It went lower about several weeks ago, went down to like about 1.7 trillion, meaning the volume that's out there. And then last week, it was like at 1.9 trillion market cap. But check it out, though. This week it's at 2.0 trillion. So it's up. So people are getting back in because it seemed like they were jumping out. Don't know if it was because of the end of the year and tax implications, why people were selling off, and some of those people who've been there for a while was taking their profits. But it's back up to $2.02 trillion. And what's so interesting, the Bitcoin, which is still the #1 cryptocurrency, it's last week it was at 778 billion in market cap. Today, as of 7 p.m., it's at 834 billion. And at one time, it's
billion, yeah.
Billion, right. But it was up to $1 trillion about 6 months ago. But a lot of people sold off. So that's some of the things you need to look at with cryptocurrency. Is keep a little eye on the market cap, the volume, and what they call what is in circulation. That usually tells you a lot about the cryptocurrency. So the Bitcoin, though, last week was at $40,985. Today is at $43,930. So that's about $3,000 increase, and it's up today about 3%. And Shiba Inu, which at one time was in the top 10 of all cryptocurrency, it's been holding about at number 15 of all cryptocurrency, and right now there's over 15,000 different cryptocurrencies out there, but it's holding at 0.00024. That's 4 zeros 24. And its market cap is up too. So people seem like they're getting back in the crypto market, though. I wanted to share with people. There's a couple of different kinds of cryptocurrencies. You got the Bitcoin's a normal cryptocurrency, but you have another cryptocurrency which is called stable coins. And there's two out there, which is Tether, and which is ranked 4th, and USDC, which is ranked 5. And these stable coins are crypto with a value was meant to mirror the value of the dollar. Like all the other cryptocurrencies, they're not backed by anything, and they're not even regulated. Remember, all cryptocurrencies are not regulated, but they're not backed by anything. But the stable coins, which is a type of cryptocurrency, it sort of mirrors a dollar. And the idea was to create a stable crypto that can be used like digital dollars. Now, unlike other cryptocurrencies, it is supposed to be 1% backed by the US dollar, according to their site. And the primary use of stable coins, which is a cryptocurrency, is that it offers some stability otherwise than the otherwise volatile crypto space. It offers liquidity to exchanges who can't deal dollars and with banks. So in the crypto space, what happens is it has a lot to do about the exit strategy, because sometimes some of these exchanges, you cannot exchange your cryptocurrency directly into dollars. And that's the thing with stable coins. It's supposed to help you a little bit because they sort of backed by the US dollar. So that's why they're stable. They don't grow as fast. They don't increase in value or decrease in value the same as the normal cryptocurrency, but it still grows, and it's a stable coin. So I just wanted to share that with you all. And there's two that's out there. One is in 4th ranked, and the other one is, I think, 6th ranked, which is called USDT, which is Tether, and the other one, the symbol is USDC. So with that my gold is doing good. It's holding. It's going up, and I just like to say that's one of those hedges that we're going to talk about in the market. So let's talk a little bit about the inflation, some strategies. What's going on with inflation?
Well, we've been talking about inflation for a while, and I'm showing my age here, but I still remember back in the 70s and 80s when everything was going up like crazy. But 2021, it all came back, and inflation ended up 7% for the year. And that's the highest it's been in 4 decades, which is just crazy. And that can wreak havoc for retirees or for people trying to build a nest egg. It hits retirees particularly hard because a lot of people are depending on their portfolios to provide income to live off. And if inflation's hammering away at your income coming in, you have less spending power, and you have that fear of not being able to pay your bills or running out of money. So it can really beat you up. And if you're not in retirement and you're just living your life, it can still wreak havoc in that everything costs more. You go to fill your gas tank up, and it's way more expensive than it's been, I believe, ever. So inflation can really beat you up. That purchasing power you lose can really have a very negative effect on you. And as it continues to rise, if it continues to rise, it's only going, it could possibly get worse. Nobody really knows what's going to happen. It could be a temporary glitch, or it could, continue, and we could have several years of this. And the Fed is preparing to raise interest rates more. And what that does is slow everything down, because the economy has been, we've been in a bull market for years now. And so the economy has been running hot in spite of everything that's going on. And so the Fed wants to slow things down, kind of tame inflation a little bit, get things back under control. So that's where we are right now. And that's why we need to talk about some things to allow you to not lose as much purchasing power as you would. So we're going to discuss some strategies to help you fight inflation.
And dope. Before I go any further, just want to give a shout out to Modestine. She wish happy birthday to your mom. My sister Nolia is out there. She's saying hello. Our frat brother Clutch Chicago wishing your mother a happy birthday. And dope, we got some people online. We got Brian Maggot, out of Montgomery County, Silver Spring, Maryland. Dope. This dude had the sweetest jump shot. That mug jump shot was softer than a baby's breath on a pillow, man. Brian, thank you for checking us out. We got the wonderful singer, songwriter, producer, John Butler. Not Jonathan Butler, but the John Butler out of Louisiana. But now he's a DC guy. My man, Derek Seals, dope. That look, grew up. This is my neighbor. How many of your neighbors are around like dope? And my man Derek Seals, thanks for being out there. And my junior high school buddy, Michael Wolfer. What's up, Mike? So thank everybody for joining in. Dope, we got a question before we get into this. Say, wouldn't agriculture stocks be a good investment right now? Right about now?
But it's hard to say, because you don't really know what's going to happen. And that, you get a bad storm or you get a bad crop. There's a lot of things that affect that, and I really don't know about it, and I don't know that industry. So I tend to stay away from industries that I'm not up on. So for me, I would never do agriculture, because again, that's so many things could happen that could go wrong. But people got to eat, that's for sure.
That's for sure. All the orchids out there, I'm sure they would love that. All them chitlin eating mugs. But don't want to say hello to my older sisters on too, Linda. Si, what's up, Linda? Glad you could be out there. Though there was another question too, dealing with people who's cloning accounts and asking for cash app money for Bitcoins and other things. Just want to let y'all know, y'all got to watch out for those. Those are a lot of scams, because I've seen a lot of those too, by the way, though. Be definitely.
Yeah.
And remember, whenever you're using cash apps, you all, the key to cash apps is it's not too many ways that you can secure them. One of the sure ways to secure or making sure your money is safe where it's going, you should never cash app to a destination that you don't know. Like I cash app to my son, my daughters, people I know. And that's just one secure way that your money's going to where it's supposed to go. But a lot of people are using cash apps for other things. I understand that. But you got to be careful, you all, because there's a lot of fraud. And once you send the cash app, it's gone. It ain't going to a bank or nothing.
Hey, Rob, another thing you should do is keep a separate bank account that you use for those cash apps, and only have in there what you intend to send to somebody. So if somebody happens to hack that account, they can you won't have anything there. I wouldn't have Cash App attached to my main checking account or the checking account that my paycheck goes in or my retirement check or whatever. I'd create a separate account and only put money in there when I need to send it to somebody. So that's all is there. And as Bob said, make sure it's somebody that you know. Because there's a bunch of scams with those Cash Apps right now. And they're even getting lookalike Cash Apps to make you think you're in Zelle, but you're in something else. So you really have to be careful when you use those. Those things can be really tricky.
So our topic tonight is going to be, strategies to combat against inflation. But I just wanted to, me and Dope, because when the questions come, we're going to answer them, even if they're not on the main subject. But just give a very important tip, Dope, since we're talking about digital things. You should always use, if you have a debit credit card, always select credit, because if you use debit and your money is stolen, it's this theft, it takes a bank or a credit union 30, 60, 90 days to refund you. The reason why, your bank could be in Washington, D.C., but the servicer that serves those bank accounts could be in Seattle, Washington, and the fraud department could be in Kansas City, Missouri. That's why it takes 30 to 60 to 90 days. It goes through all of those channels. But if you use credit, one, you're getting credit. You don't get credit using debit. You build your credit using credit. And two, credit, you can normally get your funds returned to you within 3 days. And if you have a defective product, you can take it back and get your account recredited. And you have cash rewards. So that's more than so since we were talking about Cash App and digital money, I just wanted to make that little statement so people could understand, because a lot of people still do the old fashioned way thing. Man, dope, man.
Hey, Bob, one more thing with that. Just think a debit cash is like money. Once you hit it, it's gone.
It's gone.
It's just like cash. With credit card, like Bob said, you can complain. You can say, I'm not going to pay that charge for whatever reason if you have a defective product, or if the transaction wasn't legit. You can stop a credit, but not a debit.
Correct. So just wanted to be aware of that. Now, I talked about my sister Nolia, who's on, and my sister Linda, who's on. I got all my 3 sisters on. My other sister Gloria Brown is on, man. Hey, what's up? This is so great. And that's what I want to tell y'all. We stress this. Share this with your family, man. Tell your family, your mama, your children, your grandparents, Lottie Dottie, everybody. This information is for everybody. So let's get into our topic for today. Hey, this is good. John Butler says that's the way I do it with Cash App, a separate account. Thank you. Good move, John. So let's get into our subject today. Like gold, which is commodities, treasury inflation securities, which is called TIPS, or even maybe Bitcoin come to mind when thinking of inflation hedges. While all tend to work to some extent, each has its own quirks, and none cleanly move in lockstep with inflation. That's just a fact. So let's talk a little bit about one of the first things to consider when we're looking about inflation.
Okay, and you guys know I'm an accountant. So the first thing you got to do is you got to adjust your spending and look at your spending. And so if you are doing an annual budget, let's say, and you know things are going up, you might want to consider putting a hedge in there or an additional amount, 3-4%, knowing things are going to be more expensive than you may have anticipated prior to this big inflation push. And especially if you're looking at something 2-3 years down the road, and you have to assume, let's just say inflation is going to be 4%. You should add that hedge in there to make sure your budget reflects what you anticipate things are going to cost. So you might want to adjust your spending and look at your budget, put a little hedge in your budget because you know things are going to be going up.
Yeah, that's good information, though. But with looking at the spending side, right? The spend side, you also need to look at the other side of your spending budget, which is the income side, which you should estimate conservatively so that you don't come up short. Because if you end up earning more than expected, that gives you even more money in your budget to offset against inflation. Like Doe said, so if you put an extra 4% in your savings and inflation goes low, then you to the good. But at least if it is floating around that percentage, you can sort of hedge against inflation. So look at both sides of your spending plan, which is your budget. It's so important you all to be cognizant and make those adjustments. That's the key to personal money management. Keeping a consistent look on your budget. You have your budget, but you should always consider adjusting your budget for the times.
Yeah, and if you're going to make a large purchase, and it's something that you know you're going to have to buy, you might want to buy it sooner than later because it's probably going to be more expensive down the road than it is today. And if you have to buy a car, an appliance, something, even new home, if you know you're going to do it anyway, we're not trying to tell you to run out and spend money like you're crazy, but if you're going to make a large purchase, you might want to do it now, knowing it's going to cost more down the road.
Yeah, because even though, well, yeah, inflation affects car prices, which I see, though, car prices have been going up considerably. And those are some items that if you're looking in the car market, you might want to look at because as far as on the interest rate side with the Fed rate going up, it doesn't affect car interest rates as much as immediately. But the issue with cars, though, is inflation. It's the price that they're charging. And that's what's going up. So we're not telling you to run out there and buy a car, but if you were thinking about buying a car and you were going to wait, a couple of months, you might want to consider doing it sooner because inflation is at 7.9%, the highest it's been in 40 years. And they're talking about it may go up. But the other thing is they are saying they expect it to come down at the end of the year. But like I told you about the show about the stock market, don't nobody really know. So that's why we try to give you some strategies so that you can combat against such things as inflations. The other thing, though, you need to look for help with higher prices whenever you can. For instance, you might sign up for a cashback credit card. It has no annual fee, and it gives 2.5% back on your first $10,000. Those are credit cards that are out there, and this is for and we're talking to people who have good credit and who are responsible and are accountable managing their credit card debt. Now, you people who have these large credit card balances, and because you're not disciplined enough to with your spending, we're not talking to you. We're talking to the one people who are responsible, and because you're being responsible, one of the 3 C's with any creditor is your character. Do you pay back your money on time? And that increases your score. The other is capacity. But if you are responsible and accountable, look at those no annual fees. It gives you about 2.5% back on your use of your credit card. And some of them have limits. Like once you go over 10,000, they might drop it down to 1.5%. But that's still monthly. That's still a good built-in discount against rising prices. A lot of people don't take advantage of these cash rewards. And remember, you all, if you don't use cash rewards and they're using cash and you don't use cash rewards, you basically are paying for the people who use the cash rewards. What I mean by that, whenever you use your credit card, they charge the people like Visa, they charge the retailers 3% or more, right? So that's why they encourage you when you go to the store to use a debit because they don't want to be paying that 3%. But check this out. That 3% that they're charging the retailers, trust me, that retailer is building that cost back into the price of goods that you're purchasing. And that's what I mean. In a way, theoretically, you might be paying for other people who are using the cash rewards. Now, somebody like Thomas Doty, Mr. Tight Penny Pension Accountant Man, though, can you share with people how much cash rewards you use that is tax-free?
Yeah, that's the other thing. I got a credit card that gives me 3% on my purchases. I buy my gas from Costco, I get 4% on that. I buy most of my food from Whole Foods, I get 5% on that card. And I get 5% on anything I buy from Amazon because of that Chase credit card. So I do pretty well with cash refunds. I think from my brokerage Fidelity account, I got $1,400 back last year. And again, as Bob said, that's tax free. And for my Chase card, I was up around $500. My Costco card, I read my rebate check, and I get 2 of those. One of them was about 400, and I'll get my other one in August. Last year, that was only about 2 and a quarter. But I mean, that's well over a couple grand that I get just by using my credit card. And the way I look at it, somebody's going to pay me to use their credit card. Now, I'm not talking about my travel credit cards because I have a American credit card that I use for that, and I get miles for that. Then I have a Hilton credit card that I use for my hotels that I get Hilton points for that. So I don't spend anything where somebody doesn't give me something for having spent that money. And yes, I am cheap, and I wear that title proudly.
It looks well on you too, though, by the way. So some people may say, well, wait a minute. This seems counterintuitive, Thomas Doty, to have all these credit cards. I thought the strategy backwards the day was just to have one major credit card, and that would be good, and maybe one retail credit card, but that would be it, but not have all these credit cards. So go ahead and talk to it, though.
You got to maximize what each card gives you. If I can get 5% at Whole Foods, there's no reason to use my 3% card when I can pick up 2% by using a separate card. So yeah, it's a little bit confusing, but I have all my credit cards set on automatic pilot, which means I get a notification whenever anything's spent. Because interest rates are so close to zero, I pay them off as soon as the charges hit. One, to keep the account that I use to pay bills low, and 2, to kind of help keep track of what I'm spending. I always want to make sure I know just what I'm spending. So, and if I do miss paying it off manually, they're all set to automatically pay at the due date, because that's the worst thing in the world to me is I can't tell you, other than a house interest, I can't tell you the last time I paid interest. That's just not something I do. And so I use it to my benefit.
I don't know if you see this little third, but Claire says you must got 20 credit cards.
No, I have about 6. I have about 6, and they all serve a purpose.
And so remember, you all, so check this out. What I say. But the reason why Doty can do that is because he's responsible and he manages credit cards well. Because between me and Dote and the credit cards that we have, I can't tell you when I paid interest on a credit card. Can you, Dote?
No.
So people, and I know, and don't get me wrong, we know everybody can't do that. But the reason why we do that is because we pay off the balance before the interest hit. And another little secret to that, by the way, whenever you see it's different titles on different credit card statements, but you might see current balance and outstanding balance, right? The current balance could be the cycle before, and the outstanding could be the balance that you put on after that cycle. And the key is, if you pay off the current balance, that's what they get ready to charge you interest on, right? And that's what you could pay off if you don't have the full amount to pay. We're not saying not to go that way, but if you don't have the full amount, pay off the amount that is being charged at interest for that cycle, and you don't get charged interest, and that may help you. You don't have all the money to pay the the second part of that, which is different credit cards have different titles. But anyway, just wanted to make that statement that's why Doty can do that, because he has those credit cards, because he manages his credit cards well, and we pay them off and never pay the interest. Dope, let's talk a little bit about some strategies, investment strategies dealing with combating inflation.
Yeah, and the first way to look at that, let's just use the 4%. If inflation's 4%, if your portfolio isn't generating 4%, then you're going backwards. Okay, you're not making any money. If inflation's up 4% and your portfolio is only generating 4%, you have increased your purchasing power by 0. So you got to find a way to make more than inflation to increase your wealth. And if you're retired and you're living on that, it's very important that you find something that's paying higher than inflation. And it's difficult to do. It's not easy, because all the fixed instruments now are paying close to 0. I mean, their interest rates are close to 0. So in the 70s, you could get government bonds for 6%. Not anymore. But there are some things you can do, and that's what we're going to talk about. Some of the things you can do to make sure you get a little bit more than inflation.
Yeah. So with that, bonds are also, they pose another risk. That is where we are right now. Yeah. Bonds,
Yeah.
another risk. That's one retirees may not be accustomed to after decades of mostly falling interest rates and rising bond prices. So now the reverse is true. If interest rates rise, the prices of existing bonds will fall. So if you sell them before they mature, you may lose money. So bonds actually pose and present a great um, hedge to when interest rates are going up. And we're going to talk about that a little further.
Yeah, but and the way to avoid that little pitfall is you want to do your bonds in what's called a ladder. That means that, let's just say you have 20 grand to invest in bonds, and you decide to invest in a 1-year bond. You wouldn't put all 20 in a 1-year bond. You might only put, let's say, 5 in and wait until the next year and then invest in the bond. So you would ladder them, so if there is an abrupt change in the interest rates, you can adjust. So it's like anything else. You don't put all your eggs in one basket. And if you decide to go with bonds, which we're going to talk about in a minute, then you set up a ladder, and you might do it over, if it's a 4-year bond, you might do a 1-year, a 2-year, a 3-year, just so all your money's not tied up in one place. Let's talk about tips.
Right. So TIPS, which are Treasury Inflation Protected Securities, and they pose to safeguard the principal from inflation, which would be a good move if the market had already priced in that benefit. Like, for instance, the appeal of TIPS is that inflationary periods, they pay more interest and increase in value. And that's the difference between TIPS. We'll talk a little bit about I bonds, but Treasury, that like Treasury Inflation Protected Securities. Now, there's several other different kinds of bonds, but we're basically talking about more on the Treasury bond side, more so than corporate bonds, because Treasury bonds are backed by the full faith and credit of the United States government. So that's the other security that you have there, and that's why we talked about TIPS.
Yeah, and the government bonds, TIPS in particular, they help you protect against inflation, because if inflation continues to go up, continue to increase, the value of the bonds will increase. Okay. And so when Bob was talking about it's already been priced in, since there's been a big run of inflation, the price of TIPS has already gone up. But if you think inflation is going to continue to run rampant, then, and you buy a TIP, the value goes up because they pay a fixed interest rate. So you buy this Treasury inflation protected security, it comes at a fixed interest rate, but the value or the principal fluctuates depending on what inflation does. So if inflation continues to go up, the value of that bond will continue to go up, and it'll continue to pay twice a year It's fixed interest rate. Okay. So that's where you make the money. As inflation continues to increase, the value of your bond will also increase. That contrasts with the I bond, which I think Bob's going to talk about now.
Yeah, and just remember, you all, this is the thing about dealing with your portfolio when you have stocks and bonds. The theory is stocks and bonds is an inverted relationship. When stocks go up, bonds go down. When stocks go down, bonds go up. The value go up.
Usually, yeah.
No, and I'm sorry, typically, right? Usually. We've been having a little problem lately where bonds were staying down, but normally it's an inverted effect. And that's why you have some stocks in your portfolio and why we're talking about having some bonds. The reason why we talk about treasury bonds is because they are inflation hedges that can help you safeguard and actually get an increase or give you a benefit by investing into those bonds. So the next ones, though, outside of tips, are called I bonds. They're called I saving bonds or I bonds, which are issued and backed by the full faith and credit of the United States government. And they pay interest rate. The interest rate is directly tied to inflation. As you said, as prices rise, so does the interest that is earned. Bonds are different. I bonds are different than other bonds. So it's so important to understand how they work when deciding whether they're a good fit for your personal savings or your portfolio. It's also worth noting that I bonds are subject to interest rate market risk. One of the things that set I bonds apart from other investments is their rate structure. There are two components that help determine the Series I. It's the fixed rate and the inflation rate. The fixed rate is set at issuance and persists for the life of the bond. And the second component resets semi-annually based on the non-seasonal adjustment of the Consumer Price Index, the CPI, which is for all urban consumers, and that includes food and energy. But that inflation rate, two components, and the fixed rate adjust for inflation. They are combined to get the overall interest rate. So the I bond accrued interest monthly until they reach 30-year maturity. You cap them before them. Whichever comes first. For the current period running from November 2021 to April 2022, the fixed rate that we talked about on the bond is now at 0, and the semi-annual inflation rate is at 3.65. So it's every 6 months, amounting to a composite rate of 7.12%, you all. So these rates will reset in May, and with the way inflation is going, investors can possibly expect the yields on bonds to likely stay elevated.
And a couple of things to add to that. Just be aware, you buy an I bond. It's typically a little longer term investment. If the first year you decide to sell it, I believe you lose 3 months interest. Okay.
Correct.
So instead of 7.5, you might only, if you had to take the money out in a year, you might only earn 4 point something. I don't know what that exact calculation is, but that's still better than anything else is paying. And after a year, I think the penalty goes down. And again, like anything else, make sure you understand what you're getting, understand what happens if you sell prior to that 30-year maturity date. Because I believe after 5 years, there is no penalty for cashing in. So like anything else, read the fine print, make sure you understand what you're getting. So if you do have to sell, you know just what your penalty will be. And it is minimal. Yeah.
And I forgot to make the statement. You purchase these online at treasurydirect.gov, and you can only purchase up to $10,000 per person.
Right.
But if you do them in person, if you do it in person, you can buy another 5,000. Right. Online, you have up to $10,000 per person that can buy I bond. And if you go in person, you can buy additional $5,000.
Yeah. Okay, let's change gears a little bit. Another thing you might look to beat inflation would be stocks. And one of the big staples to look, I shouldn't say staples, one of the big things to look at when you talk about stocks are dividend stocks. And you investigate the ones that have paid a good dividend for a long period of time, that has a good track record of earnings, and you can expect that dividend to continue. But it's good to get, like I bought Pfizer because it pays 3%. Pfizer's probably going to pay that regardless of what happens in the market. Okay. And any appreciation you get is then on top of that. Another type of stock you might look at are commodities, gold and silver. Those things do really well in inflationary time because of their intrinsic value. Okay. And we mentioned before, industry staples, Verizon, Procter & Gamble, Johnson & Johnson, Coca-Cola. When there's inflation, those things typically do well. Again, we're not saying they always do, but looking back at history, those kind of stocks, dividends, commodities, industry staples, have always done well in inflationary times.
Yes, that's a good one though, because especially those dividend stocks. Not all stocks pay dividends, but those dividend stocks are definitely can help you in these times of high inflation, and especially commodities like gold and silver, though, which I hold. You can hold those in person, or you can hold them at the place in the vault, or you can invest in gold and silver or iron or copper. Another big one these days is platinum and palladium. Um, there are actually funds, gold funds. You don't have to purchase actual hardcore gold, like in the ounce material physically. You can invest in, they got ETFs, exchange traded funds. They got mutual funds that have a series of different commodities in them. So you can also invest into a fund, gold fund or commodity fund. Though I want to talk a minute, a lot of people may not know about this, but it's something to really consider because this is such a good, especially with taxes and with inflation, and that's RITs. RITs are real estate investment trusts, and they benefit from both rising rents and home prices. Now, by law, RITs must pass along at least 90% of their taxable income to shareholders, usually in the form of a hefty annual dividend. Now, RITs is a pool of real estate, and you get to invest in it. And your investment, there's a couple of ways to invest, but the general way is you invest as a limited partner, meaning whatever you put in it, that's what you're limited to your loss, whatever you put in there. You can get in on the general partner side, but that's a whole nother explanation. That's getting in a lot deeper and takes more money. But RITs, people can invest in it, and let's say they're great, especially with rising rents and home prices, because they pool these properties into this account, and they pass along the gains from the seller property, and also the actual taxes and things and money that they make back on this. It's a tax. Excuse me, it's the tax benefit too. So RITs, look it up.
Okay. Okie doke. And if ever there was a reason to have a professional money manager, these kind of times kind of should lead you to that, because a professional money manager can help you navigate these risks. They might even have more sophisticated defensive strategies that they can use to hedge against inflation or whatever. So if you're going to do it by yourself, make sure you read the fine print, make sure you understand what you're investing into. And if you know,
That's me. Go ahead.
If you know you're not going to put the time in that's necessary to manage your portfolio, this might be a time you go out and find an investment manager to handle this. But this is to manage your funds during volatile times, it's very, very important to do well because there's a lot at stake. It truly is.
Though the question is, why would you purchase bonds online? And I want to tell you the question: why you purchase?
Because you can't buy them at the bank no more.
Because you can't buy them at the bank no more. Plain and simple.
Right.
That's it. So that's why they allow that online. And trade.gov, if I'm correct, but look it up, put it in there, iBonds, Google it, and it'll tell you the exact way to do it. All right, Dope, let's take this home, my man, with our summary and takeaways from today's topic. So we want y'all, this is some of our takeaways from what we talked about today. And look like inflation will be here for a while, you are. So you must be prepared for it. And that's why we're trying to give you some strategies. We're not telling you or directing you or advising you. We're just telling you some of the strategies that are out there so that you can be prepared, because it looks like inflation is either going to stay or they may increase.
And understand the effects of it. Know how it affects your spending. It's going to cost you more. Portfolio, you got to do better. And your income, you have to take into account and understand how it's affecting you so you'll be prepared for what's coming down the road.
If you are not beating inflation, you are going backwards. Meaning, if you have a savings account that is paying a CD, for instance, is paying 2%, and inflation is 4%, you're at a negative 2%. So you're going backwards. So, think about that. If you have an investment that's paying 8% and inflation is at 7.9%, you're only making 0.1%. So make sure you understand this whole inflation and how it affects your purchasing power.
Yeah, and find a strategy that works for you. Whether it's iBonds, tips, stocks, commodities, REITs, find something that's going to help you mitigate the effects of inflation, and something that you're comfortable with, something that's going to be effective, something that you think can work. But everybody's situation is different. Find something that works for you individually.
So that's our wonderful recap. We'd like to thank everybody. My man, Daryl Jackson, what's up, my brother? Glad you out there. Hope you're still sticking with us. Thank you for joining us. Please click on the like button and the heart button. That gives us more expansion into audience. That's how the algorithms work with Facebook. And also, please share this with your work, your co-workers, your family, your friends. And you can go back out on the sites and look at the archived shows that we have on. We've covered from credit to savings to psychology of money to funeral expenses. We covered a lot. This is our 43rd show. We got even more topics to talk about, and we're going to probably circle around and circle back and cover some of these other topics. But let us know. Put in the comment box of topics you would like for us to cover, and we will definitely cover those. And if we need to circle back and cover something we already done, we'll do that also. So with that, we want to thank y'all. We're here next week at 8 p.m. every Friday.
Every Thursday.
I'm trying to do two things. I can't multitask like that. I was reading the comment and trying to talk at the same time. Thank you, Doug. Every Thursday at 8 p.m., the FITT Show. Make sure if you're on YouTube, please subscribe. Please subscribe to our show, the FITT Show. Thank you very much, Dope.
Thank you, good brother.
It's great being with you, man. I learned so much from you, man. I learn something from you every day. And thank you, everybody.
I'm just waiting to see you buy that Ford stock. I'll talk to you next week.
That's a good one. Bye.
Bye-bye.